All right, how's it going, friends and family? My name is Amos, and welcome to another edition of the companies that are reporting their earnings this week. If you don't know what the earnings are, it's when a business that is publicly traded, they basically report their financial progress for the past 90 days. And then their PE ratio gets adjusted contingent upon whatever their earnings per share is. And the earnings per share is basically the profits per share. And after being an investor for about 7 years, I have learned it is so freaking important. If you disregard the profits per share, you basically don't understand why the PE ratio is the way it is, right? If a company trades for a premium, it's usually because there's a lot of expectations baked in. If a company has a really low PE ratio, sometimes, yeah, it means they're undervalued, but other times it means, dude, this company is a dying operation. But before you make any judgments, you really got to look at the EPS and their earnings and take a situational awareness of what is going on with the company. So that's what we're about to do. And if you can't tell, obviously my face isn't plastered on the screen. This is going to be more of a chill, laid-back environment. And it's weird to think that some of you tune into this while you're sitting on the toilet. Don't even lie with me. I already know. I'm your go-to guy as you drop a deuce. But it's better than scrolling on social media, right? You could listen to some of the financial news as you poop. But anyways, what you see on your screen right now are all of the various companies that are reporting this upcoming week. December the 8th, 2025. It blows my mind that 2026 is around the corner. I just wish time would slow down. I don't know if you guys can relate to me on that, but I feel like when I was younger, the days went by so slow. And the years, looking back, dude, it just flew by. So, yeah, I just wish I would have taken my time growing up instead of being like, I wish I could just be old already. Now that I'm old, I'm like, dang, dude, what the heck was I rushing for? Anyways, let's go ahead and look at each day of the week in a more detailed format. I'm going to be using stockanalysis.com. This is my preferred go-to financial website because in the past, dude, I used to open up like 10 different tabs like Yahoo Finance, Google Finance, Seeking Alpha, and all these different websites just to get the same information that's consolidated in one website, which is a stock analysis. That's why I personally use it, and that's why I don't mind endorsing them, right? Like, I have a referral link in the video description if you want to give them a look. Anyways, on Monday, it's going to be pretty quiet. I think the only one that's worth paying attention to is Toll Brothers. And they're in the business of building homes. And not for the entry-level one bed, one bath, but more of like the bougie, luxurious type of homes, right? Year to date, I would say they're doing pretty well. In the green by 10%. But if you flash back 1 year, it's negative 10%. That's pretty funny. So once you add in December of last year, then it's a pretty disgusting stock. And in the past 5 years, we're talking about 190%. In 2020, $44 a share. They're currently $138. And I'll tell you this, okay? I'm not a real estate guy. I'm never going to pretend like I am. However, what's funny is I turned down a real estate strategy gig to join a strategy team at a pharmaceutical company. In hindsight, sometimes I think about that. I'm like, should I have taken that job in Dallas? I mean, the compensation was pretty good, right? It was $180,000 plus the hiring manager was telling me about the bonus is contingent upon how many commercial buildings we can close, blah, 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 blah. But then he kept going on and on about, like, we work Saturdays and Sundays. And I kept thinking, like, well, hold on, this is a 7-day-a-week type of gig? And then on LinkedIn, I found an associate that works there, and I asked him, I was like, dude, how many hours are you putting in? And he said, like, of actual work, about 50 to 55. And then the 15 hours is like, you know, going golfing with clients, eating lunch with them. So all in, he was saying in an average week, they were putting in 70 to 80 hours a week. And at the time, I was like, dude, like the pay is really good, but My gosh, man, that's a lot of hours. And that's why I decided to join the pharmaceutical company, because literally I worked no more than 35, 40 hours a week for a little less compensation. And I think it was worth it. So keep that in mind. I'm not really a real estate guy. I mean, I almost was, but I'm not. However, based on my elementary understanding of the housing market, I think the dynamics are shifting right now. Because from like 2022 up until, I would argue, the middle point of 2025, it's been a seller's market. Meaning homes that are supposed to be selling for like 200 grand, dude, they were going for like 350 grand because there were people from like California, from China, paying like $100,000 over the asking price, right? And I mean, if you're trying to sell your home, of course you're going to go with that, right? If you can pocket an extra 100 grand on your home, of course you'll do it. Whereas in the past, I think homeowners that were selling their house, they would take into the consideration the stories of the interested buyers. Like, oh, this is a young couple trying to buy their first home versus a billionaire that's trying to buy his 100th home in the neighborhood. But I don't think people care about that these days. It's money talks. But now that the dynamic is shifting, we're seeing lower transaction volume as told by Zillow.com, meaning less and less homes are actually flying off the shelves, and homes are sitting on the markets for longer. So in the past, I don't know, like a year and a half, 2 years ago, if you posted your house on Zillow.com, it would be sold by the end of the week. No more than 48 hours. But these days, it's common to see a home that's been publicly listed on Zillow.com for like 180 days, 300 days. I'm telling you right now. And I think it makes sense. You know, I thought about it. The homes right now, dude, they're 100 to 200% overvalued, especially when you look at the historical valuation and prices. Like, nothing changed. It's not like they upgraded the plumbing system. It's not like they renovated the bathrooms. No, everything is still the same, and they're just trying to charge you more. And when you think about it, the mortgage rates, I think right now it's like 6.5 to 7%. So when you take all of those factors into consideration, how the homes are overvalued, the mortgage rates are ridiculous. I mean, who the heck wants to buy a home right now? And that's why I'm saying it makes sense. However, I think during the pandemic in 2020, and especially in 2021, do you remember when the federal funds interest rates, it was like 0.2%? Dude, the mortgage rates were literally nothing. So homes were selling hot and fast. So it made sense back then, but that's no longer the case. And I also think that's the reason why Toll Brothers is thriving right now. I think there's an inventory issue. People that already own a house, they don't want to sell their home to move to another place because they'll have to lock in to a new mortgage that's going to be historically high. Because if they bought their house during the pandemic for like a 2 or 3% mortgage rate, you probably want to keep that, right? Which means if you're trying to buy a home, you'll probably looking to buy a new construction from Toll Brothers. And that's why as I take a look at their financials, it makes sense as to why in Q3 they just absolutely crushed. But I guess being the devil's advocate, if you bought your house for like 300 grand during the pandemic and now it's like 450 grand, the equity value, honestly, I would sell it, right? I would sell it, pocket the difference, and move on to another home. Even if the mortgage rate is slightly higher, but I don't know. That's just my thinking. And I've also never been a homeowner, so take what I just said with a grain of salt. So with Toll Brothers, I mean, the market feels pretty bullish about them, right? They reported their last earnings back in September, and they popped to, what is that, like a 142? But since that point, they've been dropping, and now they're 138. So to be honest with you, I don't know how things are going to go on Monday for Toll Brothers, but if I had to make an educated guess, I think they're going to continue to be crushing it, and they'll probably soar to new all-time highs. Then again, I'm not a real estate guy. Neither am I going to pretend like I am. Let's move on over to the next day. See if there's something that's more familiar. There's AutoZone. There's Ferguson. There's so many people that are passionate about O'Reilly's, AutoZone, and Advanced Auto Parts. And I think I understand the logic. Here, let's just talk about it. Year to date, 19% into the green. Trading multiples of 26, future trading multiples 24. They don't pay a dividend, even though they trade for 3,800. And the reason being is that publicly traded back in 1990, one? And they've never had a stock split. So 51,000% ROI. It's pretty good. Most companies like Walmart, Amazon, Chipotle, they do stock splits, right? To keep the stock price reasonable. But don't ever look at this valuation and say, oh, the company is way too expensive. Always be looking at the valuation such as the trading multiple. This right here is a better indicator of if they're trading for a premium or not. This is not. My gosh, that's actually really beautiful. But I think this makes sense because from my understanding of the used car market, more and more people are driving their cars to like 200, 250,000 miles on the odometer. Whereas in the past, I think whenever we got near 90,000 or like 95,000 on the odometer, it was time for us to trade it in, right? Because you didn't want to run into any transmission issues, engine issues. You just wanted to get rid of it, out of sight, out of mind, get a new car. But I think these days, the price of cars, just like houses, dude, it's ridiculous. So I think people are hanging on for another year or two. And then consequently, you have to do more maintenance, right? I think from my understanding, I'm also not a car guy. I used to be. I was a huge Honda boy growing up. But something happened where I just don't care about cars anymore. But when I was like 15, 16, 17, dude, I was so obsessed with cars. I used to be a part of all the different and various Honda car forums. I'm talking about it like 2004, 2005, 2006. I was obsessed with cars. But anyways, what was the point that I was trying to make? Something about trading in cars. Well, anyways, like the used car prices are so ridiculous that people are just hanging on for another year or two. And so consequently, you need to spend more money in order to maintain an older vehicle, right? Oh, that's what I was trying to say. My rule of thumb is after a car reaches 120,000 miles, if we're talking about an Asian car, such as a Subaru, Toyota, or a Honda, I think that's when the maintenance costs start to rack up because that's when you got to start replacing everything slowly, right? But if we're talking about an American car, as a general rule of thumb, like a Ford or a GM or a Jeep, Chevrolet, Ram, I think anything beyond 60 or 70,000, I think that's when you got to start putting in quite a lot of costs in order to maintain the vehicle. But anyways, I think people are understanding that cars are they're not made the way they used to be in the past, where they would break down at 100,000 miles. I think now it's normal to be driving a car that has like 200,000 on the odometer. Before I moved to Japan, I think I already told you this story before. I used to own a Honda. I mean, it doesn't come as a surprise. And I think I had like 180,000 miles on the odometer, and that thing drove like it was day one. It was so smooth. And the only thing that I ever did to it was change the oils every 7,000 miles. And I changed the brake pads. Other than that, nothing else. That car was smooth. And I think I did something with the timing belt at like 120,000 miles. But yeah. Having said that, I think the businesses that sell you car parts so that you could do DIY projects to maintain your car, I think they're thriving right now. And I understand why that's happening. Whereas, like, if you take into consideration, like, the car dealerships, the ones that are trying to sell you the cars, bro, they're struggling. CarMax is one of the biggest used car dealerships in the U.S., and, dude, they're just suffering. Right? $38 a share. The last time they were 38 was basically like 2010. I guess that's a hyperbole because they were like 35, but I guess when's the last time they were 38? So like 2012. And their revenue, yeah, it's been falling off a cliff since 2022. So I don't know. Regardless of how things go for AutoZone, I'm not interested in them. Like, I get why you guys are invested into it, and I think it makes sense. But if you didn't buy into them a year ago or 2 or 3 years ago while they were still undervalued, I don't think it's the right train platform to jump onto. For me, I wouldn't want to. Ferguson, I would say they're just lukewarm, especially when it comes to the HVAC space. And then I want to talk about this one, because today, it's Monday here in Japan, and I've been researching about Domino's. By the way, they've been crushing it domestically. Internationally, another story, they're kind of struggling. But domestically, I think when the times are tough, people always default to buying pizza, right? So I think Domino's is one of those companies that I'm going to be dollar cost averaging into this week as they continue to trade at around that 400 to 395 mark. But Casey's, this is a... how do I describe this? They're kind of like Wawa or Buc-ee's. So not only do they operate gas stations, but they also run a restaurant within the gas station itself. And they're famous for their pizza. And dude, when I tell you that this company is crushing it, PE is a 36, and you might be like, what? I would never pay 36 for a gas station stock. But check this out. 1 year performance, 36% into the green. Past 5 years, 196%. Maximum timeline, we're talking about 1984 to now, 64,000% into the green. And that's why I'm telling you, this is not financial advice, but you can find hidden gems and a success story in any sector or industry in the stock market. You just have to pick the highest quality compounder of the bunch. Now, obviously, there are other gas station stocks that are absolutely trash. But Casey's, dude, their pizza... The reason why I know about this is because they're giving Domino's a run for their money. Their pizza enterprise is just thriving. And that's why it doesn't come as a surprise that their revenue is up by 8.7% year over year. Taking a look at their free cash flow. And wait till I show you their dividend profile. Their free cash flow went up by 70% when you take into account the past 12 months. That is absolutely bizarre. Let me show you their dividend profile. Here, you take a look at it while I take a sip of some milk. Dividend yield, I know, it's nothing to write home about, 0.4%, but take a look at the growth rate. 15% dividend growth rate. Payout ratio is 13%, meaning out of their bottom line, they only use 13% of it in order to finance the dividends. And the dividend growth of 15%, you got to think about it. A company is not going to grow their dividend by double digits unless they know for a fact that their bottom line, which is their net income, is also going to grow at least 15, 20, 30%. From what I have seen, usually the dividend growth rate is about half, up to like 75% of the growth rate of the bottom line. So that means their bottom line is probably growing at a rate of 30%. Or 20%. And as you take a look at it, I mean, this is just phenomenal. I think during the pandemic, they paused growing it for a quarter or two, but then they went back on track of growing it. I mean, this is phenomenal. And just to verify, so if they're going to be able to grow their dividend by 15%, I said it's going to be at a minimum 20% growth for their bottom line. And what is the case? I am wrong, because their bottom line per share, it grew by 13.5% year over year. So these guys are playing it pretty close, playing it pretty dicey. So I guess we could mend that little general rule of thumb. I think the EPS, no, dude, check this out. So for Q1 of 2026, their EPS grew by 19.5% if you break it down on a quarterly basis. So that's why they were able to raise their dividend by 15%. So no, we're going to stick to it. The dividend growth rate is usually an indicator of how much more profitable a business is becoming. So if you see a dividend growth rate of like 3%, that means the company is just barely increasing their margins and barely increasing their profits. You see a dividend growth rate of 15%, then it shows you under the engine, under the hood, man, that car is just firing on all cylinders. So Casey's, I think, is a really good company, but I think that ship has sailed, friends and family. I think it's too late. I wouldn't want to buy into them. But pretty high quality company. And then what else do we have on Tuesday? Do we have anything? Dude, the Campbell company, I don't even want to open up that can of worms. But I think their executive vice president of IT or whatever, dude, he went on record. One of the employees leaked an audio message of him saying like, "Oh, our food is just highly processed crap that's made for poor people." And after that, dude, their stock just got absolutely hammered. Past 1 month. Oh, wait, what? Okay, there you go. After that memo was leaked, and also with what's happening in the food CPG space, dude, this stock has just been getting brutalized. And it's not just them, right? I feel like the food CPG companies at the top echelon, the leadership team, dude, it's kind of questionable. Because I remember like a year or two ago, I think the WK Kellogg or Post, one of those cereal companies, he went on record by saying, "Dude, I think high inflationary times is a good thing. That means more people can enjoy our cereal." Like, how, like the optics of that, to be able to, everyone around you is a yes man. Because how the heck did not a single person, to include a summer intern, how did no one say, "Sir, maybe we should pause and refrain from saying saying something stupid like that"? That dude went on record by saying, "I'm glad that the prices of groceries are going up. That means y'all could eat cereal more for every meal." It's like, dude, you're tone deaf. And their stock also went on a PR nightmare because of that as well. So I don't know what it is with the food CPG companies, like at the top level. Y'all gotta pay some money to have some PR lessons, because, yeah, that's a hot mess. So Campbell, I'm not going to go near. I don't even care what's going to happen to them on Tuesday. I really don't. And if you're curious as to why I'm feeling so strongly and negative towards the food CPG stocks, I posted up a really long research report on Patreon. Dude, I spent 5 days looking into all of the variables and factors, and that's the conclusion that I reached. I'm really bearish about the food CPG stocks, which is weird because, as you know, if you're a friend of the channel, I always said, food CPG stocks are pretty much buy and hold forevers, but I don't think that's the case anymore. GameStop, we have a meme company, we have Korn Ferry. Oh my gosh, can we just take a moment to talk about Cracker Barrel, please? Dude, Cracker Barrel, if you're not in the know, this is it's a restaurant chain in the US that their menu is literally like walking into an old Southern country style restaurant. You can have grits, you could have country fried steak, you could have mashed potatoes. It always hits the spot, okay? And it used to be one of the best dividend stocks prior to the pandemic. And what I mean by that is if you take a look at their dividend history, this company used to crush so hard in their operations that they used to pay a special dividend every single year that was like 300-400% above the normal dividend payout. So like in 2016, they would pay you $1.10 every quarter, and then bam, they would hit you with $4.40. And then in 2017, the exact same thing, 2018, 2019, and then the pandemic happened. And after that, this company cut their dividend, as you can see right there, going from $1.30 in 2024 down to 25 cents. And they've just been in a... It makes me sad to say, because this was one of my best performers at one point. Obviously, I sold out of them. I sold out of them at the height of the pandemic. Like once they reached the valuation of like 175-ish and they were dropping, I think I sold out of them at like 160. I was like, okay, I'm jumping ship. Because I think I kind of understood that Cracker Barrel, their days were limited. Because when you think about it, right, they're usually located along the highway or the outskirts of towns, middle of nowhere. They're never going to be in a downtown location or in a college town, like in the heart and center of that town. So Cracker Barrel, it depends on a bullish travel industry. And during the pandemic, obviously people weren't traveling, right? So when I thought about that, I was like, dude, I don't know about this one. So that's the reason why I jumped ship. But ever since then, they also started running into operational issues. So they're kind of in a pickle right now, and that's why they're trading for $27 a share, which is so crazy, because the last time they were $27 a share, that was like, hold on, we can zoom back even further. The last time they were $27 a share was 1992. Dude, that's absolutely bonkers. Their current trading multiple is at 13.5. In the past, they used to be like a 24 or 25 because their numbers were pretty solid and decent, right? Leading up to the pandemic. And at the pandemic, obviously it fell off a cliff, negative 17%, and then they recovered, and then they've pretty much been flat for the past, what would you say, like 2.5 to 3 years? So the company is not growing. And in the summertime, they also had a brand campaign fall flat. It was actually really funny. They tried to change their logo to be more palatable and less country style because their logo features like this cowboy with a rope. And I think the leadership team, I think the logic, I understand what they were thinking. They wanted to appeal more to the masses, and it looked just like Denny's. Their logo was pound for pound a copy of Denny's. But it didn't work because it just absolutely pissed off their core customers beyond belief. Because people that eat at Cracker Barrel, it's not the young people that are 19 or 20. If you're 19 or 20, dude, you're going to Taco Bell, you're going to McDonald's, or you're going to Chipotle. The Cracker Barrel's core customers are usually like people that are living on their Social Security checks, on their retirement pension, 60, 65 years old, 70 years old. You go to Cracker Barrel, you drink a cup of coffee, you have some hash browns and some eggs. That's their core customer base. And they were so vocal on social media. I remember, dude, I was laughing. I was looking at the Instagram of Cracker Barrel, and all these old people that were like 81 years old with like a selfie of their double chin as their Instagram profile picture. They're like, what are you doing? I ain't never going back. You hear me? I ain't never going back. And like that comment was repeated like 500 times on all of their posts to the point where Cracker Barrel, they had a reverse course and they said, fine, we won't use the new logo anymore. So this is a company that's just, they're just running into so many issues. They don't even know what their identity is anymore or what made them successful in the first place. They need to double down on the whole Southern heritage and image, and without the racism, of course, and serving the hot, like, Waffle House, but a more upscale and home comfortable vibes. Because Waffle House is the kind of place you go into at 2 a.m. in the morning after a night shift, and you might even catch two people fighting, right? Waffle House is not a family-friendly restaurant, in my opinion. Because I've only been there like once or twice, and I personally saw some people fighting there. And I was like, dude, what in the hemoglobin is going on here? With Cracker Barrel, it's a different vibe. Because each restaurant, it kind of feels like you just walked into an 1850s log cabin in the Wild West. They have like furniture and decoration that's like 200 years old everywhere. It has an entirely different atmosphere. And they're trying to make it more corporate. You know what I'm saying? Make it plain Jane like the new McDonald's or the new Starbucks. But I just feel like that's not the selling point of Cracker Barrel. Cracker Barrel is the kind of place you go to for a greasy-ass country fried steak or some fried chicken or for mac and cheese, right? Like, you want to go there for that comfort Southern meal. And the fact that they're trying to turn themselves into being a more bland, vanilla, plain Jane, run-of-the-mill corporate restaurant is like, bro, I just feel so bearish about this company. And I feel so sad to say that because they were one of my favorite stocks in 2018, 2019. So to see what happened to them, I'm so glad I jumped ship. But if you're thinking about buying into this company, I don't know what the logic here is because I think this company is going to suffer. I don't think this company is going to be thriving anytime soon, especially when their competition is rolling out new endeavors and they're crushing it. I feel like a parallel restaurant that's kicking it, crushing it, is Chili's. I think Cracker Barrel, they need to hire some people from Chili's because Chili's, they offer like that Tex-Mex, kind of like a Cheesecake Factory. You can almost get anything there, right? Tacos, cheeseburgers, wings. But with Chili's, they understand their brand and image, right? It's the kind of place that you go to to drink a pint while you watch a football game, or you can also take your family there. I would argue Chili's probably gives you a very similar experience to Texas Roadhouse, except actually no, they both offer a menu that's super affordable. I don't think you'll pay more than $11 per person. With Cracker Barrel, they've also been experimenting with their menu too much to the point of like they're losing their how do you say it? They're losing their identity of like what they used to serve. They're trying to serve healthy, clean stuff, and it's like, nah, dude, you don't go to a Cracker Barrel for a vegan meal. You don't go there for a salad. And the fact that they're trying to play into the whole health movement, I'm like, bro, could you see my train of thought? And that's why I really don't like, this is not, sorry, it's Brinker. I'm so sorry. I can't believe I went on that tangent while showing the other company. This is Chili's right here. They also own Maggiano's, which I think is so much better than Olive Garden. But I also like Olive Garden, right? Chili's has just been doing pretty well in comparison to Cracker Barrel, all right? So I personally think Cracker Barrel it would behoove of them to hire someone from the Chili's team, because that is phenomenal for the restaurant space, especially when Cracker Barrel is seeing stagnant and flat numbers. So Cracker Barrel, I do not care about, and I'm not going to be paying attention to them on Tuesday. I think that rounds it out for Tuesday. Let me see if there's anything on Wednesday. Let me take a sip of my little milk here. Feel like a little baby drinking my milk. All right, friends and family, I think we need to talk about it. Oracle. $620 billion market cap. The expectation is $16 billion of revenue in 3 months. Earnings per share growth of only 2%. I think there's a lot that I can say about Oracle. This is an interesting one because in September, as you can see, they were roughly 223. They announced a $300 billion deal with OpenAI, which is the parent company of ChatGPT, and their stock price absolutely went to the moon. It went from 223 to easily 328, over $100 overnight. But since that announcement, as you can see, if we do, the past 1 month, this company has just been selling off every single day. Because I think the market's understanding that emotional greed made investors pile their money into Oracle. Just because you announce a $300 billion deal with OpenAI, it does not mean that it's going to be rainbows and sunshine for your company. And to make matters worse, to make good on their end of the bargain, Oracle's about to spend a filthy amount of money on CapEx to expand their data centers, and when you think about it, their financials, let me show you this. Their financials are not as pretty as the Mag 7. Case in point, right now I'm on the cash flow statement, and if you take a look at their free cash flow, how do you feel about that? 2024, $11.8 billion, and now it's negative $5.8 billion of free cash flow. That's what I mean. And when I show you the culprit, it is capital expenditures, $27.4 billion. They're building out their data centers in order to support this deal with OpenAI. My take on that, I think it's a good thing. I'm bullish about that. However, I think the markets are kind of like, maybe, because here's the thing, Oracle is one of those ancient tech companies like IBM or Cisco, right? You can't really think of them in the same vein as Google, Microsoft, that are also doing amazing endeavors in AI. Oracle's trying to make that pivot into being relevant in 2026, 2027. But the thing is, to go from being an ancient tech company where your platform and software is kind of booty hole to trying to be in the tip of the spear of the AI movement, I think it's more hype than it is with operational tech. I think this company needs to prove it and show Wall Street like, dang, I think OpenAI loves us because of XYZ. I mean, their revenue growth is pretty impressive to say the least, but I don't know. I think I'm kind of on the fence. I don't know if I feel bullish about them or bearish. What I do like, though, is their dividend growth is 18% growing year over year. And something else to keep in mind, I think this is the X factor, is Oracle's leader, Larry Ellison. Okay, a funny story about him. I think I just read a news story like a month ago. Dude, he married a Chinese chick that's like 30-something years old, and Larry's like 80-something years old. I thought that was pretty weird, but I guess love is love, right? I'm sure she married him for love, not money. But anyways, Larry Ellison, he's butt buddies with the president. Like, I mean, they're really close. So I think Oracle should see smooth seas for at least the next 3 years, because I think the president's going to take care of him, right? But that's contingent upon OpenAI being the best. So if OpenAI continues being the pioneer and best in class for their language learning model, then I think Oracle should also benefit from that, because they're going to be the ones that are supporting their entire infrastructure, right? With their data centers. But I would argue that Google's Gemini is better. I know that's a hot take and unpopular, but yeah. So if Oracle, here's the thing, okay? The trading multiple is a 50, forward is a 30. I don't think they're undervalued. I really don't. I think they're fairly valued, but I will say this. After they report their earnings and they go on a massive sell-off, I'm talking about going back down to like $100 a share, like they did back in April. You know, for the love of the game, to have some skin in the game, for content, I might jump in. I might pick up a few shares. My conviction level isn't very high with them, and I think after I finish filming this video, I'm going to do a proper deep dive to figure out, like, what is their game plan, what's their roadmap, and what's their strategy. Is it just going to be a data center pillar for OpenAI, or what is their other pillars? Because if that partnership falls through, or OpenAI decides to partner up with somebody else, like IBM, for instance, I think this stock can tank really fast, right? So I want to see if everything else checks out before I make that executive decision to jump in. I think that's a horrific situation. $67 billion of cash on hand on the books, and now we're talking about $11 billion, but it makes sense. Once again, they're spending money to build out the data centers to increase the bandwidth of OpenAI. So I understand why that's happening. Oh, golly, bro. $111 billion of debt on the books. I mean, you can't really turn a blind eye to that, right? But I think the more proper way to assess the leverage situation is a debt to EBITDA. A 4.2? Ooh. Guys, I don't know about this one. There's a lot of yellow flags. I mean, I think this might be premature to say, but I think besides their top line, the rest of their financials and fundamentals, it's looking pretty rough as they make this pivot into becoming a data center powerhouse. So I think I'm going to have to do a deep dive to figure out if I even really want to jump in or not. Anyways, going back to the earnings calendar for Wednesday, there's Adobe. Dude, there's so much I can say about Adobe, right? I use their products every single day, and they've been seeing a tiny little rally in the past month, right? Or past 5 days, 8% into the green. I think at one point they reached their absolute lows of about like, well, he says $311. That must have been intraday price. Now they're $346, and I think they're seeing a little pump before they post their earnings, because I think there's insider knowledge that probably got leaked that things are looking good for them. And I think for the longest time, Wall Street, hedge funds, and other investors, they don't understand that Adobe, they're integrating AI into all of their features and software, right? I feel like people are so dramatic by saying Adobe's going to be obsolete. They suck. Oh, I can't wait until there's new startups so I can start using that instead of Adobe. But the fact of the matter is, Adobe's best in class. Fact of the matter is, they have contracts with almost every major enterprise in the US. You go to the marketing department for Coca-Cola, the marketing department of Meta, the marketing department of Google, Amazon, they're all using Adobe Suite to make their Instagram posts, to edit their ads. Adobe's products, it's here today, and it's here tomorrow. And the whole idea that AI is ruining them, I feel like you guys don't understand. I run multiple YouTube channels, and I can tell you that there's AI features in every single one of their software. I think the bigger question is, can they monetize it? Because I think for the longest time, as they roll out these new features, they're not upselling, right? I think instead they bake it into the subscription price, and that's a whole different argument. I know on a personal level, like the lady who lives out of her van, she probably hates Adobe because the subscription price tends to go up year over year. And I don't blame her. I feel like I remember even leading up to like 2011, 2012, you could just buy Adobe for like $45 and it's yours, right? Now you can't do that anymore. You got to pay a subscription every month. Otherwise it gets canceled. But for these major corporations, do you really think they're going to jump ship and move on to a startup company? No, I don't think so. Now, and then of course there's the whole, the acquisition of Figma falling through. I think that was a huge blow. I'm not gonna lie. That was bad. That was a bad look. But, I mean, if you take a look at their financials and fundamentals, I would argue this is probably one of the best financially sound, undervalued companies right now in the market. And that's not financial advice. I'm just saying, for a company that's posting the numbers that you see on your screen right now, to be trading for a forward trading multiple of like a 16, it does not make any sense. Like, my gosh, dude, this is, shoot, I might even dollar cost average. So I need to look into Adobe after this video alongside with Oracle, because this is a really good reminder that this company is just crushing it. They're flush in cash. Let's check out their debt situation. A 0.73. It would take them 8 months to pay off all the loans on the books by just using their core operating profit. That's really good. What about their shares outstanding? And they're buying back their shares. It's going from 507 million shares in 2015 down to 433 million shares. The only thing I have against them is they don't pay a dividend. I think they really should. I'm being serious with you. I'm going to have to take a look into this after I finish filming this video. I think I might have to buy into Adobe. I still think they're really undervalued. So thank goodness I'm making this video. Sometimes I get good little reminders to revisit some companies. So Oracle and Adobe, those are the two I need to, just making some mental notes. We also have Chewy, the Amazon of pet online e-commerce. Not really bullish about them. Although I really do like their customer service and the way that they treat their people. Let's see. Anything here that sticks out? Wearable devices? What the heck is that? A $10 million market cap? Dude, that's a micro cap company. What about Thursday? Thursday, we have Broadcom. I really like this company, but I'm so sad that the ship has sailed with this one. I used to be invested into them. I bought into them before their stock split for like, I know this might sound like fake news, but at about like $30 a share. And then once they ballooned up, this is prior to the stock split, okay? And once they ballooned up in valuation, I jumped ship. I wish I would have just held on because my ROI would have been closer to like 950%. But I think I was satisfied with like a 250% total return. And I just uploaded a video talking about Marvell technology, which I think seems to be the better bargain right now in the customizable AI data center chips space. But Broadcom, I think the ship has sailed. It's too late. So I still think it's very high quality. If you're invested into Broadcom, kudos to you. And yeah, you have a really awesome business in your portfolio. Go back to Thursday. Costco. So do you remember how I told you I wrote up a research article that took me 5 days that I just posted onto the Patreon? Costco is featured in that deep dive. And I gotta say, I understand why their trading multiple is so high now. I see the light. And I'm telling you right now, if they go on a massive sell-off from this earnings report, it might be the excuse that I needed to finally jump back in. I used to own Costco back in 2019, 2020, and in 2021 and 2022, and then I sold out of them in 2023. I know. Why did I do that? I was being short-sighted. But I love this company. I'm being serious. I love the way that they treat their workers. I love their products. I love their economic moat. And yeah, this is a company I'm definitely going to be monitoring on Thursday, because if I can buy in, dude, I'll be so freaking stoked. Which means you'll start seeing content about Costco. Lululemon! Dude, I just made a video talking about them. I still think they're very high quality, but I think this earnings report is going to be very extreme. Meaning, if they don't post rosy numbers and their guidance is not bullish, I think the stock could fall even further. And yes, even though in 5 years they're down by 50%, I'm talking about they could drop down to like 150, 140, 130 a share. I'm not kidding. But if they crush it and they kill it on Thursday, I think they could pop and touch 200 again. Personally, I like Lululemon, but it's not a company that I want to invest into, because apparel retailers, it's really hard to predict when the drop-off is going to happen or when you have to jump ship. I would argue it's not a buy and hold forever, because it might be their time now, but in 10 years from now, they might be the ugly girl, right? Same with Decker brands, same with Nike, same with Columbia Sportswear. Like, you really don't know who's going to thrive and who's going to fail and crash, like Abercrombie and Fitch. But also, what's the other one? VF Corporation, the parent company of Supreme and North Face. Yeah, just not a fan of the whole cyclical nature of apparel retail. Dude, Lovesac. When I was in middle school and high school, whenever we went to the shopping mall, dude, we would always go to Lovesac and sit on the couch. It is pound for pound. I would never buy the stock, but I'm trying to say that their couch, their sofas are so freaking comfortable. If you own a Lovesac, you made it in life. And I say that because it costs thousands of dollars, okay? And then on Friday, let's see if we can talk about, National Beverage Corporation. This one's lesser known. I think everybody knows about Coca-Cola, PepsiCo, Keurig, Dr. Pepper, but nobody really knows about Fizz. This is one of the companies that I had to analyze for my accounting classes back in grad school. And it's actually the parent company of LaCroix, sparkling water. So it's an interesting one, but I think my takeaway 6 years ago is that it's not a company that I would want to invest into. Especially because everybody, right? Everyone's rolling out sparkling water to the point where LaCroix no longer has an economic moat or brand proposition for the customers. Because now we know sparkling water pretty much tastes the same regardless of who makes it. But that's not true, because here in Japan, there's a brand called Strong. Like, literally, that's the name of the sparkling water brand, Strong. Dude, that thing is so carbonated that you'll start having hiccups and burping the moment you take a gulp. So I guess the amount of bubbles they put in that bad boy is intense. But for the most part, the American variety, like bubbly, LaCroix, or the ones from Aldi and Lidl, I think they all taste the same. So yeah, I think that pretty much wraps it up for the earnings reports. And before I sign out of here, I'll give you some announcements. I'm going to be doing a working example of what to look for when it comes to the cash flow statement as an investor with Pinterest. It's going to be a working example. I'm a man of my word, and that's because there's an individual that keeps commenting on my videos saying, can I please analyze Pinterest? And I told him, hey, if I get one more person to join the Patreon, I'll do it. And this week, we finally got someone to hop on to the Patreon. I'm so freaking happy, so grateful. So being a man of my word, you will be seeing a video about Pinterest coming up. There's a lot to like here. I'm going to tell you that right now. I've been researching them for like the past 2 hours prior to filming this video. And then so far from what I have seen, I like. And as the year wraps up, right now it's December the 8th, I think probably in a week or two, I'll be doing an analysis of all the winners that I sold this year. Because do you remember how I uploaded about a week or a week and a half ago? The losers that I sold this year, how I lost money. Well, I'm going to be sharing with you the companies that made me a ton of money this year. So pretty excited about that one. And then a quick update on the baby. If you don't know, I'm a first-time dad. Had a daughter back in mid-October. And dude, can you believe that she's turning 8 weeks old this week? Like, time flies by. And apparently the definition of a newborn to toddler and to infant and all that, it changes, right? Depending on the timeline and milestones. After 8 weeks, they're no longer considered a newborn. And that's when they're categorized and classified as a baby. And I'm like, dude, it's insane. And just to see her growth, like she was born around 6 pounds. I would argue she's probably closer to 12 pounds. To gain 100% of your body weight in 8 weeks, dude, that's insane, right? And I guess some positive news. I think as a parent, I think we're starting to figure it out, right? We understand that the baby operates in small cycles. Feed, diaper change, sleep, and repeat. And because we're starting to understand her cues of like when to burp her, when to change the diaper, when to feed her, is she full? Like, I think in the first few weeks, struggling, right? Because they cry for any reason. Like, you don't know. But I think as we're spending more time together, we understand and we can proactively troubleshoot before she screams. And that's why, if you've noticed on the channel, the ops tempo for the uploads, it's been good again, right? I've been uploading frequently because I'm getting more time on my hands because after we do the whole cycle, she goes back to sleep. So, I don't know, I feel pretty blessed. I've been praying a lot that her digestive system would develop and that we could figure it out as parents. And I think, dude, I'm about to jinx myself. Just because I said that out loud, I feel like she's going to be demonic today. Like she's going to be a little gremlin screaming her head off. But yeah, it's not been too bad. I feel like the first few weeks, absolutely miserable. Dude, I was dying. And I'm not even exaggerating. I was literally dying. But in the recent days, not as bad. It doesn't mean that I'm not tired though, because it is still a lot to deal with. I told you, right? It's kind of like taking care of a friend on their first night out drinking or whatever. They're 21, they're hammered, they're puking, they're spitting, they're pissing themselves, they're pooping their pants, and you gotta keep taking care of them. And it's tough. I haven't been this tired since running night missions as an infantry officer. But I was also 21 at the time, right? Now that I'm 35, dude, it's tough. It's so much tougher when it comes to the whole neglect of sleep and everything. But I don't know, things are getting better, and that's what I'm thankful for. And right after this video, I'm gonna make some small edits. I'm gonna upload it, and then I'm gonna be taking down my workstation. I'm gonna be sanding my table, and then I'm gonna be putting a protective coat on it. And I've been procrastinating on that for 3 years. So can you believe that I've been using a raw, unfinished, pure wood table for 3 years? Enough is enough, because the other day, dude, I started getting splinters on my own desk, and I was like, all right, this is it. I'm gonna freaking sand it down. I'm gonna put a clear coat on it, and I'm gonna put a finish on it and make it nice and smooth. So because of that, I don't think I'll be able to upload for like 24, 48 hours because it takes time to dry and to do another coat and then to dry it. So just a heads up, okay? But anyways, if you make it to the end of the video, can I just please tell you how much I appreciate you? Thank you for supporting the channel, and I hope these videos bring some sort of value to you. Having said that, I love you guys. Stay safe, good luck in the stock market, and I will talk to you next time. See ya.